Here we are with a new analysis. Today, let's take a look at the US dollar. It seems, to be in a bit of a weak spot, doesn't it? Several analyses suggest so. Yes, exactly. The bearish voices are piling up. But careful. Careful about what? About positioning. It looks like investors are already very tilted toward this idea of weakness. So the question is, how much of this decline is already, so to speak, priced in? That's exactly the point. Let's see if the sources can help us understand it better. We have quite a bit of material. Refinitiv, Deutsche Bank, JPM, UBS, Bloomberg data. Let's try to put the pieces together. So, let's start with Refinitiv and technical analysis. There's an interesting chart of the Eurodollar, the long-term one. And what does it say? It shows that the Euro-USD exchange rate is close to a significant downward trend line, and the 200-week moving average is still pointing down. So it hasn't moved that much since 2015, basically. Exactly, little ground covered. So maybe all this recent enthusiasm for the euro might be a bit, let's say, premature in the short term. A strong technical resistance could signal caution, yes, at least in the short term. But if we look longer term, there's Deutsche Bank. What does DB say? They suggest we might be at the end of a long bullish cycle for the dollar. Years long. And why? What are the causes? They mention several. Changes in US trade policy, German fiscal stimulus, possibly less global interest in US assets. And then there's always the famous twin deficit, right? Trade and budget. Exactly, which becomes harder to finance if interest wanes. So DB throws out a number. What number? Year, USD toward 1.30. 130, wow. By when? By the end of 2027. They see it near purchasing power parity, the theoretical fair value. That would be a major shift in scenario if it happens. And JP Morgan also seems to see strength in the euro, or am I wrong? Yes, JPM notes something interesting. Looking back, when there were accumulations of long positions on the euro similar to now. What happened? They were often followed by double-digit euro gains, so they say their targets, 1.20, 1.22 by year-end, might actually be low. Okay, so JPM is optimistic on the euro based on historical positioning. But there's a but, exactly. JPM's own model calculates a short-term fair value. And where is this fair value? Around 1.1050. Wait, but the current exchange rate is well above 1.1050. Exactly. JPM itself says this is the biggest overshoot above fair value since 2017. But that's quite a contradiction. How? How do they explain it? On the one hand, they say it could rise a lot, but on the other, it's already above fair value. Good question. It's a clear tension between historical analysis and current valuation. It casts doubt on the immediate sustainability of the rise, for sure. And then there are capital flows, I think. Another factor against the dollar. Yes, here Deutsche Bank uses a colorful expression. No bueno. No bueno. For what? For capital flows to the US, they've noticed a sharp stop in the last 2 months in foreign purchases of US bonds and stocks. What? Despite asset prices rising? Exactly. Despite the recovery, foreigners seem to have stopped or even sold off. A sort of buyer's strike. Foreign buyers strike. Powerful. And that clearly weighs on the dollar, especially with the twin deficit. Of course, those capital inflows are needed to finance it. And UBS? They're bearish on the dollar too. They recommend selling into rallies, I read. Yes, UBS lists 3 main reasons. Let's see. First, political uncertainty in the US. They say it will remain high, which undermines the idea of American exceptionalism. The idea that the US economy is always the best, no matter what. Exactly. Second, yield differentials. They'll likely move against the dollar if US growth slows as expected. Okay, and the third? The Fed. UBS expects the Federal Reserve to resume easing monetary policy, maybe earlier or more than other central banks that might hold steady. I see. So politics, yields, the Fed. Many factors pushing the dollar down, according to UBS. Putting all the pieces together, yes, the picture seems to point that way. But, as we said at the beginning, this bet against the dollar, this short, seems very crowded. DB also shows it with a chart, right? It's grown a lot. True, positioning is a key factor. Many are already on that boat. And there's also that strange thing, the divergence between US equities and the dollar. The S&P 500 is rising, but the dollar index, DXY, is falling. They usually don't diverge like this. That's an interesting point. The spread is very wide. What does that mean? That maybe strong dollars are no longer needed to buy US stocks? Or is there something else behind it? Quite the puzzle. So, let's try to sum it up. On one hand, we have solid fundamental reasons to expect a weaker dollar in the medium to long term, US. Politics, deficits, slowing capital flows, expected Fed moves. Okay, that's the bearish scenario. On the other hand, though, we have technical signals on EUR, USD calling for short-term caution and especially this investor positioning. Everyone is already short the dollar. Exactly. And when a position is so crowded, there's a risk. It might limit further declines or, worse, trigger sharp reversals if sentiment shifts. So the situation is far from simple or settled. There's a tug of war between long-term fundamentals and the more immediate technical and market picture. Exactly. The dollar's prospects really seem to be hanging by a thread, a delicate web of economics, politics, and, well, investor psychology, which currently appears very unified in its view. And to close, maybe a thought-provoking point. Well, going back to that foreign buyers' strike, the fact that they hesitate to buy US assets despite rising prices. Yes. Beyond the immediate impact on the dollar, what kind of deeper shift in global confidence toward the United States might it signal? That may be the most intriguing aspect to watch in the near future.